Hi, everyone. It's Grant Abbott and Michael Jeffriess. G'day, mate. How are you?
Good, thanks, Grant.
Good. And Mr. Sunderji, hopefully I'm going to see a lot of you guys. Oh, look, LightYear Docs, Trust Distribution Resolution System. Never, I can tell you, out of all the things I've ever done, and I remember when I first started doing tax law, and you're looking at this particular issue around trusts, etc. I remember it was way back in 1986, and I was doing my Masters of Law, and I had a session at that time, and capital gains had just been in, and imputation was about to be dropped in, and I had Dr. Richard Van, who ended up being on secondment at OECD, Professor Ross Parsons, the emeritus professor, who's an absolute legend and wrote the book on income tax. I had Graham Cooper, who was the professor down in Melbourne now, Rob Deutsch, and all these guys were all sitting around, and they were going through and pouring through the Act and considering what would happen, for example, and I thought this was great at the time. I know Macquarie Bank made a fortune out of it, but effectively with dividends flowing through a trust, if they were heavily geared, so as long as you got $1 of income flowing out from the trust to a beneficiary, that all the franking credits could flow out as well, which was quite amazing for me. And I must admit, I was sort of sitting there as a youngster, just fresh out of uni, shaking my head about all this sort of stuff. But it really was light years ahead of its time. And, from that perspective, opened my eyes up that trusts are completely different beasts. I mean, self-managed super fund is a trust, but it's more of a unitized or fixed trust, as are also obviously a typical unit trust. But once we get into discretionary trust, there's a whole lot going on. And more importantly, as we'll see very shortly, it all comes down to the deed, because the deed itself is actually the law. So whatever's in the deed is the law. And that's where a lot of people get tripped up. No doubt, Mick, you've seen a lot of deeds where, they're probably 20 or 30 years old, and there's no way in the world they've got any categories of income or ability to stream.
Correct. I mean, I not even 20-year-old ones. I've seen some fairly new ones recently. We're talking about some clients that we'd acquired, and it's interesting in seeing where accountants had just used a blanket distribution minute or resolution and hadn't even, it's quite obvious, hadn't even read the trust deeds. So I've been showing the team in relation terms of going through and having a look at that deed. And I was mentioned to you one deed in particular that had the trustee, appointer and beneficiary as the same company, so corporate trustee. And then they'd done, over the last 2 years, had done distributions to individuals and children. And of course, when you read the deed and you go to the clauses in the deed, doesn't allow that. If there had been an individual name, certainly as one of the primary beneficiaries, but when you read the clauses, it says doesn't allow. Anyway, so the trust distribution resolution, if it was picked up by the ATO and read, it's actually incorrect. And
I think that's really important about everyone who's on here is that, I've got a Masters of Law, Mick's got a Bachelor of Laws, and also obviously accounting. But Michael's also has a very successful accounting practice. What are the sort of fees generally that your business down on the Gold Coast has?
I mean, most of ours are SMEs and mid-sized businesses. So I mean, our average fee base is probably about 15 grand. But certainly something like this gives the opportunity and potential to go through and upgrade deeds when you see that. And as we've spoken, I certainly love having all my deeds upgraded each year and with the same provider, because it actually makes the process a lot easier and streamlined. If they are, I mean, obviously some clients don't want to pay the money, but I mean, Change GPS is a great system from the front end in relation to getting consent from clients on a number of different strategies and things such as deed upgrades and stuff. So it's, I certainly find the administration a lot more streamlined if they are.
I think it's important that, everyone who's part of the LightYear Doc system is just to know that, it's not like a class. It's not like, other document, there's real people behind it actually solving real problems, you know, day on day. And I just came off the phone. In fact, I had a couple of calls today, and you know, I would put our advisors right up there now. I'd really started to see that momentum, that understanding around the leading member concept, and out of that is starting to evolve this living trust, which is really crucial. So trusts are obviously going to be absolutely crucial for us going forward. And it's a matter of understanding what is in the trust deed and reading it. There's plenty of trusts around, but unfortunately, there's some good ones, and as Mick said, there's some bad ones. Importantly, I just wanted to point out, and the thing that I noticed when I first came into that trust world is that accounting and tax laws are completely different. So, for example, if a client gets a cash flow bonus from the government, that'd be treated. You generally treat that as accounting income. But it's tax exempt, so it's not taxable income. So that has that cash flow bonus going through a trust is a category of itself. And that's important, is that when we do come around to categories, there's an ability under tax law to define things as separate categories. So you can have a cash flow bonus as its own category from a tax perspective. The question is then going up the stream, because it's always trust law first, then tax law. So I'll just say that again. It's always trust law first, then it's tax law. So what we need to do is, if we want to have that category, because the cash flow bonus, we need to go upstream and see whether our deed enables that. I want to look at that a little bit later on. Here's another one, a classic one. So a pension member of a superannuation fund. So we're not looking at trusts now, we're just looking at generalities to show that accounting and tax laws are different. A pension member of a super fund receives a pension from a super fund that is accounting income of the pension member. So it's always going to be assessable. Now, if they're under age 60, it's assessable income to them. But if you're over age 60, it's neither assessable nor exempt income. So it's funny how an age can actually change the same accounting concept completely different. Client purchased a truck for $120,000 under AAS4, that's accounting standards, got to write it off over its effective life. But under tax law, particularly the instant asset write-off, you can actually get a full deduction for it when it's paid. And Michael just noted to me there, and one of the issues there, Michael, is when we come around to that and we're trying to distribute, if we've got all these instant asset write-offs, you know, how does that impact the general discretionary trust?
Yeah, well, I mean, we were just sort of going through an example earlier, but instant asset write-off can change it from being, especially if it's the trustee allows it, the distribution under taxable can turn it into there being effectively no distribution. And even expanding on that, it's interesting, the instant asset write-off. I've been working with our funding or finance partner over the last couple of weeks, and he's been bouncing a couple of cases off me in relation to where he's they're having issues in terms of getting funding across the line, because all these people are writing off vehicles and other assets.
Yeah.
250 grand is actually putting them in effect taxable loss positions. So and
they can't get
finance. Serviceability comes into question. So which it's really important. I mean, especially in terms of the trust deed and everything, and when you're doing the financials for the trust, to which we always do, is obviously do them on an accounting basis first, then have a tax reconciliation. Yep. Within the financial statements is another page, so that reconciles back to the tax return. So you've got your accounting, your accounting profit, and then versus your tax profit. So, and I know it, certainly not LightYear Doc members, but I've certainly seen a number of accountants, I guess, with the increase in cloud systems such as Xero, sort of shortcutting that process, and often doing a lot of stuff just on a tax basis and not creating those accounting records.
And that's absolutely crucial, is that they are quite different. Even we had a chat with Wendy Lenoble this morning. I was just on an email, and she was saying that the super fund has prepaid rent for 12 months, and that the auditor won't won't sign off on it, but that's quite correct, because from an accounting perspective, it has to be same as if you're paying up front for our fees. It has to be amortized over that period of time. So 12 months rent, but under tax law, that prepayment's fully deductible this year. So you can start to see, and a lot of my time, particularly when I was at KPMG, I was in that funds management area and dealing with some very, huge, big property trusts. And of course, it's always going to be the big thing you have to do is look at the difference between tax distributions and also accounting distributions. So you'll be able to distribute out from the trustee both what we call tax-free and tax-deferred income. So they weren't assessable, but effectively they were a gift to the unit holder in terms of cash. However, what they did do, though, is they reduced the actual cost base of that unit itself. So this whole philosophy about it is we need to get out of our head and just say, okay, well, we've got accounting income and we've got taxable income. Now, don't feel as though we're going to spend a bit of time on that today, but don't feel as though you're a dunderhead if that becomes pretty confusing, because it's confused the tax office, the Commissioner of Taxation, for a long time until we got to Banford, where at least the High Court cleared it up in a very succinct judgment. So we'll have a look at all of that sort of stuff as well. From that one, I think I've got, okay. So if we have a look there, some of the issues that when we have a look at trusts around this, in Banford, I'll just give you the main thing is the High Court said that a trust is not a company. So we can't just assume everything goes in and, we've got directors and shareholders and everything's out of pot. More of a fixed unit trust is akin to almost like a company, but everything, the natural tendency in terms of a trust, it's a flow through mechanism. So it's nothing like a company. In the Henry Tax Review, they looked at making trusts potentially like companies, but that all fell by the wayside. One of the important things there is the trustee, as I said, the trust deed itself is a set of laws that apply to that specific trust. So that set of laws don't apply to a completely different trust. By its very nature, you're going to have different primary beneficiaries. So you're making a little bespoke set of trustee laws for your clients, which is really important because we want to make sure we've got the security, certainty, but also the flexibility as we go down the track. And that's absolutely crucial. And of course, then you've got your state trustee acts that apply. We've talked about this before. I'm not sure. I looked at this when we did our trust deed week last week with Tim. One of the important things is when we have a state trustee act embedded within the discretionary trust, you'll find that there's a question, certainly in LightYear Docs, is what jurisdiction of laws do you want to apply to it? And the reason we ask that is not for some, stupid reason. We ask that because that is what the relevant state trustee act will. So you've got, if you look at it, you've got the laws that relate to the deed itself, and then you overlay other laws that come in on it. So, for example, if we choose South Australian trustee laws, then as a jurisdiction, then it means the rule against perpetuities, the ATO rule, doesn't apply to that trust. Notwithstanding that all the assets and the trustees may be outside of that jurisdiction. However, if we don't make a choice, then we have to go and look through, it's called a conflict of laws designation to find out which jurisdiction should apply there. And that may well be where the trustee resides or where the property is. But failing that, the easiest way is obviously the jurisdiction. There was a case just in 2020 where the Fairfax Retirement Fund, which was a trust, fixed trust by nature, changed from New South Wales to South Australia's jurisdiction. So the rule against perpetuities didn't apply. So again, there's authority there that we can change jurisdictions as well for that. And again, those things are not a resettlement, as we'll talk about a little bit later on. So the question for our trustee and our clients, and more importantly for us, because really we're in the firing line, and I don't think people understand that, is when we're recommending trust deeds or when we're dealing with trust deeds, we need to make sure that our resolutions, which need to obviously evidence a passing out of distributions or income, or whether accounting or net income, to our beneficiaries, actually match up with what the deed says. So, for example, you're going to find most, and maybe even some modern ones, but certainly pre-2010, there was really no ability to stream or categorise income. But now we've got Bamford, etc. It's brought a whole new regime. So if we division, we can upgrade the deed. So this is the big this is the big hardcore one in terms of trust, and this was in the High Court of Australia, and that's Commission of Taxation versus Bamford. And essentially what happened in that case is that the trust distribution resolutions made, a certain dollar amount to this and a dollar amount to that, then a certain dollar amount to a charity. And of course, the commissioner came in and said, well, you can't do dollar amounts, etc. You need to have some percentage. And as a consequence of that, there was going to be a lesser amount going to charity, obviously, because if there was a dollar amount, essentially it would be caught up as being tax-free if it went to a charity. So the key things about that is, again, it's always trust law first, then tax law. So the court came out and basically said that the trust deed is its own law. You need to have a look at the deed. And again, it's not going to be any different between this, a unit trust deed, or an SMSF deed. Those documents that we create are laws unto themselves. And you can get in a situation that if you breach those laws, obviously there's a right of action against anyone who breaches the law, and can even go up to criminal penalties if you're looking at self-managed superannuation funds. Importantly, you can change the deed without a resettlement. This came through in FCT versus commercial nominees. The commissioner argued that, if you change the beneficiaries or the trustee, that effectively any capital losses or income losses in that trust were evaporated. But the High Court didn't have anything of that and said, look, if you set up a trust, you can change the appointor, you can change the jurisdiction, you can change the vesting date, you can change the trustee, you can change beneficiaries. As long as it's that's based on exactly the same trust, then effectively that trust doesn't come to an end. And a resettlement means you're taking assets out of one trust and putting them into a new trust. So essentially we're in a pretty good position. Now the main thing that, of course, the High Court said is that if you are upgrading or varying the deed and making changes to beneficiaries' appointers, that has to be in line with what is required under the trustee. Failure to do so, that obviously creates a big problem. So in terms of the trust distributions, I'm going to have a look at it. We need to review the deed and see what can be actually characterised as income, even though it might be capital. So, which is exactly the case. It was quite funny that in the Bamford case, they were distributing a capital amount to a charity. And as a consequence of that, obviously the commissioner wanted to try and knock that one on the head, and basically was arguing that where the word income is used in the Tax Act, that's only income under ordinary concepts, which means that it only be, for example, rental income, interest income, so on and so forth. And the capital was to be excluded, so it didn't include statutory income. So it was a good try from the commissioner. And it's funny because if you took that reasoning and applied that over to non-arm's length income, which deals with income from a discretionary trust, on that basis, you would say that income was never going to, any income coming from a discretionary trust to SMSF was never going to be classified as a non-arm's length income. So you can't have it both ways. But anyway, the High Court knocked that on the head and said that it depends on what the income definition is for that trust, that income set of laws there. And essentially what they held there is that the income definition enabled capital amounts to be included and therefore distributed. So that was a fairly important point. So we need to be quite open. Let's have a look at, and I'm going to take us just through the LightYear Docs deed, but what I've got here is, I'll come back and have a look at it. But what we want to do is have things really wide open. So under the LightYear Docs, I'm going to show you a couple of deeds. Income of the trust means that amount is determined by the trustee. So that's the first thing, is we've got the trustee has complete flexibility as to the determination. So if we just do that, it really means, well, basically anything. And notice in that one, you don't want to have, and I have seen ones that say that income is as required under Australian accounting standards. And of course, the recent kerfuffle we got there is the last thing I want. So here, income is going to be whatever the trustee determines. Now, including accounting income, and if the trustee makes no such determination, income means all profits or gains less expenses taken into account in calculating the net income of the trust, and exempt income as defined in section 51 of the Act, notwithstanding the whole or part thereof may otherwise constitute capital of the trust. So what we've got is wide open slather. You can bring in anything you want, but if you don't make a determination, then we've got to go down to net income. And the reason we do that is if we fail to distribute net income, then it remains in the trust. And under section 99, it's going to be taxed at the penalty tax rates, or the top marginal rate, plus Medicare levy. So we've got a really good definition of that income. And I just want to show you the difference. So this is another deed I was just reviewing recently for a client of Abbott-Family. And we've got here, subject to subclause 3.2, the net income of the trust fund shall be an amount equal to the net income as determined under section 95 of the Income Tax Assessment Act, but reduced by any amount which would otherwise be included by 207. That's okay. 3.2, notwithstanding clause 3.1, the trustee may in any year, in any part of year, determine the net income of the trust fund in accordance with ordinary income concepts. So that there again, ordinary income is again reference back to taxable income. Now, the problem is if you've got this sort of clause within your deed, then the only thing you can actually distribute are going to be net income. You can't distribute accounting income that is not net income. And I think that's pretty crucial for that one. So that is a very, very weak clause. What I want to do is just bounce out of here, and I've got our LightYear Docs, and I just want to show you how it works the way through the clauses. And there's not that much to it for us to look at in terms of its simplicity, and then I can hand over to Michael, who'll take us through making trust distribution resolutions. Now, this is our standard discretionary trust. It's not a leading member one, which deals with bloodline beneficiaries. So this is a much more open set of circumstances. So again, you can see here, we've got appointors, we've got succession of appointors, which is good. We've had a look at that before. A category in relation to income or capital of the trust fund means that part or those parts of the income or capital which the trustee has separately identified, characterised and recorded in the books of account of the trust, so they may be separately distributed. So there we can do capital gains, we do cash flow bonus, we can do anything we want. So again, we've got that flexibility of category. Obviously, even under the one before, we wouldn't have seen that. We've got beneficiary. We'll come down. We can see here, we've already looked at that. The income is the amount that's determined by the trustee. So I just want to go down and have a look at the beneficiaries. So this is under our deed. At year end, we can distribute to the primary beneficiary, their spouse, any child, grandchild, great-grandchild, the primary beneficiary, any other relative, bucket companies, secondary trusts, transfer to distributed superannuation funds if we want, but obviously it'll be non-arm's length income. We can send it to any charitable trust. So there's that field of beneficiaries. We can also add additional beneficiaries. So a natural person who is not a beneficiary under clause 3.1 may become a beneficiary where the trustee, with the consent of the appointer in writing, so determines. And you can add those people as beneficiaries, and that comes in under LightYear Docs. You'll see addition of designated beneficiaries. You can use that to particularly do that. You can delete a beneficiary, of course, if you want to do that. And then there's obviously capital beneficiaries as well. So we talked about income of the trust fund. So if I just have a look at this one and we go through here, the trustee shall stand possessed of the income of the trust fund. Now, what's the income of the trust fund? Well, we don't know until the trustee makes an actual determination. And remember, it's got wide open flexibility as to what they want to do. If it's just accounting income, that's completely different to net income, then they can do that. for financial year which is available for distribution upon trust to pay, apply or set aside the same or any part or parts thereof to or for the benefit of the beneficiaries, or any one or more of them exclusive of the other or others, which is that enable. What that's doing, that's saying we can stream within there, if that makes sense, or others who shall be living or which shall be in existence at the time of payment. Application or setting aside of such income is made in such shares, so that's okay, or proportions, and from such category or categories of income as the trustee in its discretion may determine. So that's, I love that. I love that clause because it's flowing back to the income. We can choose whatever we want. We can categorize, we can stream all to one person, to a group of persons, etc. And really it's the true discretionary trust. It gives the trustee complete discretion what to do. Further, the trustee may refuse to disclose to any person the reason why the trustee exercised that discretion, as the trustee did, may refuse to disclose to any person those materials referred to by the trustee in exercise of that discretion. So you don't want a potential beneficiary or someone coming in saying, well, why are you doing that? That's going to be really important when we start building these living trusts that are going to last for generations to come. So you don't want people coming in and try to take an action against the trustee for that. So I love that clause. That's one of my favorite out of the lot. We talk about accumulation, manner of allocation there. If we have a look there, we've got the payment allocation, setting aside of income may be effectively made as follows: for beneficiaries not under legal disability, by paying the same to the beneficiary to such person, trust, superannuation fund, a company on behalf of the beneficiary as the beneficiary may authorise or direct. So once we get the resolution, this is how you allocate after that. So I can pay it, I can just simply tell the trustee, please pay it here or please pay it there, or be setting it aside to a separate account. Now there's a whole lot there for people or minors under legal disabilities, which I won't go in because it talks about education, etc. We talk about the effective trustee. I won't go in there, but essentially what it means is once we make the resolution, then effectively that's binding upon the trustee, and then the trustee can basically wash its hands of that. Now, of course, there can be UPEs in terms of that, but what we really need to do is get into that first stage is finding out the present entitlement or making the payments out. So here we've got the payment application or setting aside of income to or for the beneficiary under legal disability in accordance with provisions of clause shall be effective, constitute a full and final discharge in that receipt. So that deals with the other one. And it's exactly the same there for non-legal disabilities. We've got capital, obviously, which is quite separate. So it's a corpus of the estate. And I just want to go in here before we hand over to Mick. Categories of income. So we've already referenced that back. We know under the definition of income, we're going to have categories of income. When we make that distribution under 4.1, we can do it in categories of income. Now, what this is doing is it's just opening it up. It's providing us, it's like a sub-chapter. So our first chapter is, yes, you can have income. Second chapter is, yes, you can have categories of income. Now we've got another sub-chapter, which is, well, what are those categories of income? And I love this because it goes through the trustee may in the books of account and records of the trust separately record each of the following categories of income. So dividends, whether they're fully franked, they're unfranked, or if there's a foreign tax credit because there's a foreign tax dividend, or any other separate identifiable consequence or benefit is attached or arise in relation to dividends. So it's giving me that flexibility of anything that might happen. For example, I might have a dividend from Timbuktu, and in that it has a cocktail umbrellas that come with the dividend. Then under this, effectively, I could distribute those cocktail umbrellas to a specific beneficiary. Now, it sounds a bit far-fetched, but we want to have that flexibility. Income, including capital gains, under the Act, which has got Australian source, where it has a foreign tax offset, so on. So we've got capital gains and we've also got dividends. Now, 6.2 is important. Basically, it says the trustee may identify and separately record and maintain in the books of account and records of the trust income or capital, having on respect of which there is attached individual or unique characteristics other than referred to the preceding subclause. So, for example, a cash flow bonus, that could be a separate category. So we've got wide open ones there. 6.3 is really important. So what we've got there is a resolution of determination of the trustee by which income of the trust fund is distributed or accumulated pursuant to provisions of clause 4, remember we looked at that, may separately deal with the whole or part of the income of a category that so that the same or any part thereof may be specifically paid, applied or set aside for the benefit of any one or more of the beneficiaries, exclusive of the other or others or accumulated. So that was much the same as 4, but what they're doing is it's a sub-chapter saying that, well, we can do dividends. We've seen a 6.1, but 6.3 elaborates on that, enables us to also do that as well. So we're doing that. We can also here, I won't go into it, but you can allocate expenses and outgoings in any manner, shape or form that you see fit. So that's the basis of our deed, which is really important. Compare that to, for example, the deed that we had a look at before, which was a nightmare. We're virtually stuck there to be able to deal only with the net income. It doesn't even talk about anything to do with streaming. But anyway, I'll just bow out there and then might get you to share your screen there, Mick, and I'll handle any questions that might come up in the chat or the chat line.
Yeah, I've seen Brad Smith's put in there, for unit trust, do the same minutes work or something different in relation to the resolution? Well, unit trusts are set in relation to the unit holders. Yeah. So these trust minutes are in relation to making a resolution because it's discretionary trust. So it's a trustee's discretion at before 30 June on how it distributes that income, whereas a unit trust is set by the unit holders. So
yeah, generally you'll have, if you want to have different distributions, you'll have different classes of units. In a hybrid trust, which we showed last week, you can effectively have a unit or fixed entitlement, but from that fixed entitlement, you've then got discretion for a nominee to distribute to as you see fit. With special disability trust, do we need to do trust distribution resolutions? Absolutely. So the problem is if you don't do distribution resolutions, as we've seen, the money gets stuck in the trust. And we've heard from Tim Munro, myself, and everyone that we need to have these trust distribution resolutions effectively up and running by the 30th of June, even if we have a percentage. And you'll see when we go through and Michael does his stuff, once we've embedded and we've built these trust distribution resolutions on the LightYear Docs system, as long as it stays much the same next year, we can just come through and reprint those trust distribution resolutions. So it's absolutely crucial for that one.
And I was actually going through, Grant, just as you're going through the deed, then I actually was punching in a lot of the information, and it just shows you how quickly it was. Probably the last 2 minutes of you finishing off, then I effectively went through and I think I completed 95% of the resolution minute. But as you stated, it's great for the next year when it rolls over, because you can actually go through, in effect, jump ahead to say financial year, if it's the same year, and just change that. Change obviously the date of the trustee minute, which I haven't put in there yet. I was leaving that, and then just update your distribution and have a review of that. But so just stepping through, obviously as per the normal LightYear process, we have the document set up. I've used the Abbott-Family logo tag there. Goes through and set when the actual trust was originally established. So you go through and review, obviously turning to your deed again, as we've shown the importance of the deed. Entering the trustee details. I've put the trustee as LightYear Group, Pty Ltd there, which we've just almost closed another successful capital raise, final capital raise in relation to the rollout of LightYear Docs 2.0, which is coming along fantastic, the development of that. And I'm so excited to be able to show everyone. Our team's been working extremely hard on that, and and there's some really good stuff coming out there. So the trust, as we go through and put the trustee, obviously the trustee registered address, directors, I've just quickly put in myself only, just a ease of time, but you can add, if there's more directors, you can add, and we can put it to and add the details. The trustee minute. So as Grant was talking about before, it's extremely important that this happens on or before 30 June. So if we put, so this year, 30 June is going to be on a Wednesday. We can put the time of the meeting. I'll put 11:30 a.m. I attended. So depending on what we put before in relation to how many directors, So if I would have added another one back there, so if I would have gone back and gone 2, and we had obviously add Grant, we'll add myself in, I'll say MJ, and that I'm going to sign, and we'll also put GA as director. That'll now flow in through who's attended. So we're going to tick that both have attended. Chairperson can be Grant, and and then we put where the actual meeting was held. Now, as I jump into ours, I guess a big difference between our trust distribution minutes and a lot that I see out there, and is that ours are somewhat quite complex in terms of that it looks through and has it all, look at all the relevant clauses which Grant just went through. And I was showing our team last week this, and I think it's important because it actually allows you to go through, because you have to actually look at the trustee that you've got in your office for each client, and you actually have to go through and see if these relevant clauses are in the deed, and if they're not, as Grant said, we have to look at whether this is an opportune time to upgrade the deed. So we've got, if it's not there, then you leave it obviously blank or NA, because you can't put it there if it's not included. So this first section goes through how does the trustee determine the income of the fund for the year. So the trustee, so we've got to turn to that. The LightYear Doc one, I believe that's what we've got as the example there, 2.1. And then goes through what are the classes and types of income and capital. So Grant was talked about before, whether the deed has classes or whether it doesn't. Ours does, so we'll put it in there as 3.3. The composition, and this goes through in the composition and calculation of income. So how income's calculated, whether it's via accounting or via income tax purposes, and what clause that relates to. So you'll need to turn to the trust deed again. You can see the common pattern here, that how important the deed is. Income calculation. So I've said that we're doing net income per the Income Tax Assessment Acts. So I've ticked that. You can, if the trust deed says per accounting income, then obviously you would tick that. Distribution of the income, discusses how income is actually distributed and how it's treated in relation to that distribution. So 2.7, financial year 2021 I've put in, because we're dealing with the 2021 financial year. As Grant said before, this is fantastic in terms of when next year I can just roll it forward and just go 22, and I can update the date of the meeting. So obviously you've got to make sure and you go through, but certainly the administration team, it makes it very simple to roll this out again. Specific entitlement. So this is where we deal with streaming. So if the trustee allows for streaming, so streaming of franked distribution, streaming of capital gains to different beneficiaries, then we would tick on yes. And I've put it by way of example that one beneficiary will receive a stream distribution, and one will receive, a company will receive one as well. So e.g. a bucket company. So myself, I've received 100% of the capital gains. I could have put a dollar amount here. This is where it's extremely important also to have your financials of your customer up to date, or your client up to date, to be able to allow you to determine that. And then for the company, I've put MIC Proprietary Limited is getting 100% of the franked distributions. I've put, given it's my birthday tomorrow, Grant, I thought it was fitting that I took 100% of.
It's your 39th birthday, isn't it, mate?
Yeah, it is my last year and 40. So unfortunately not. I'm happy to continue with that story. So then anything in relation to, so if we haven't got streaming, then the next, so if I would have had no there, or any balance of any income, then we go through and put that through as the trust income. So anything that's other taxable or non-assessable or non-exempt income, such as cash flow bonus. So I've just ticked on one individual beneficiary. If the deed allows for remainder, so I've put remainder of X. So if there's any other income left over, we may put a charity here. We'll put a Grant Abbott Trust Fund. Got a registration number, and we might have put, if I hadn't got the remainder of X, or we might have put $55,000 there. The last part deals with if there's any variation of income within the trust. So this is where, so the Commissioner of Taxation comes in, and there's been a variation post year end or post lodgement, then who do you want that to go to? And it's important, once again, the trustee allows for that. Our trustee does, but so I might have put Grant in here. We'll get under 2.1. We'll get, if there's a variation of income, I really would go to him. through that science section. So last section is we always do a check, general check in relation to who I expect will come through as signers. And we'll go through and finish it. Quite a simple process, especially when you've got the trustee in front of you. My team's gone through and created a spreadsheet of all the different trusts in the office and had a look at the deeds and actually gone through and it's made the process a lot easier. And obviously we've had ones roll over from last year as well. So you can see how quick that was. Adobe. And we can scroll down and have a look at those minutes. So we've got the minutes of the trustee. Goes through and talks about who attended as we went through and put that, who the trustee was. So noting that the trust deed and the date it was established, noting that the clause in relation to the income of the trust, the character of the income, as we mentioned, the determination income, the distribution of the income, the proposed distribution as we put through, so specific entitlement. So that streaming section around capital gains, frank distributions, and then the remaining income that we talked about that would be distributed. And then obviously if there's a variation, then you can put that. You do also have the ability to create, so if you create your minutes pre-30 June, there is an ability when you go through and do your final tax return, if it is different, to actually minute that and make a statement in terms of that. But 30 minutes. How's that, Grant?
It's pretty good to me.
Have we got any questions?
Yeah, as I said, it's pretty good. There's a couple of questions. Steve has asked a good question around UPE, and I'll just chuck on the chat here. Is the Commissioner's guidelines around UPE. So having a look at, again, you need to have a look at what your deed says. In terms of our deed, once the resolution is made and the beneficiary is notified, that effectively that amount of money or that thing is not part of the trust anymore. So it's full discharge. So the question there is it a UPE or is a UPE effectively a loan? If you have a look at the thing I just sent through from, did I send it through? We had a look at the link I just sent through. The Commissioner would treat a UPE as a loan if it goes down to a company, obviously. So you've just got to be really careful about that one. And
we also tend to like to, from a risk protection mechanism, EO likes to put a loan security in a PPSR over UPEs, right? So because they become a secured party then, so they're secured ahead of unsecured creditors such as the Australian Taxation Office and others.
Yeah, I think there's I did have it in the back of my mind many years ago, is a couple of things we can do for UPEs. We could create a loan agreement, which is fine. So that's the first one. The other one is use a promissory note. So that's available on the LightYear Docs platform. Just do a search on promissory note. So that that goes in, it could be a long dated one. So that's akin to a loan anyway, but it's more of a form of money. So you can use a promissory note there. Or alternatively, if you do have a entitlement, you can't get rid of the tax liability. Otherwise you get caught under Section 100A. But you can shift that, so you can actually gift that UPE over to, for example, a family protection trust. And that goes the same thing as, remember exactly what Michael was talking about there, is if we've got a UPE that's actually sitting inside a trust, and that's a trading trust, then we can get in all sorts of trouble. So if we gift that over or transfer that over or sign it over to our family protection trust, it's going to sit in the balance sheet as an asset in that family protection trust. It's probably better to secure it, again, as Michael said, through a venom optimum in your PPSR. So then if something happens, it's actually going to end up in the family protection trust. So I'm probably a bigger, I think I prefer that gifting over. And of course, there's always the ability there, you've got the UPE and there is a loan and you do evidence it by way of a loan, that if it's through a PN, you can always endorse it back to the trustee, which effectively extinguishes it. Or alternatively, you can do a forgiveness of a loan in that instance as well.
Philip's got a change GPS, doesn't ask for the deed creation date. Is this crucial? It's not crucial. However, it does provide, I believe, evidence to support back to the deed that you're referring to, just to ensure that you're, it's the actual, as you go through and read the deed. What's your thoughts on that, Grant?
Yeah, same sort of thing. I think the preference is, again, when we have a look at the date and you have a look at all the law, particularly around the High Court decision, 30 June is the magic date. We've all got away with it anyway, so that, obviously percentages are probably one of the best ways of doing it. And we've all got away with it for a long time. But again, I remember getting a Chinese fortune cookie once and said the law never sleeps. The law never dies, it just sometimes sleeps. So at some point in time, the commission is going to come back, and I would probably say that it's just going to be a ruling. All hell will break loose, and then we'll end up, from that day onwards, we'll have to make resolutions by 30 June, particularly with the deed, because otherwise it's too easy for him to use Section 99 and tax everything at, 47%.
Yeah. Shane said, is the resolution? Yeah, and the resolution is made pre-30 June and you are held to it, but there is the ability, if you have a look on, which I can send out to everyone, there is actually ATO guidelines around, you can actually effectively make a resolution of rectification of the prior statement that was made pre-30 June. But it's extremely important that you make your resolutions pre-30 June and you don't do them, I think you're saying up above, when you're completing the tax return, you have to make these resolutions and minute them pre-30 June.
Exactly. It's like an investment strategies forward-looking document. So we've got Helen here. Can you choose to do the distribution as a resolution rather than minutes of the meeting? Well, what happens first is you have to have the meeting, is the minutes, and then the trustees resolve. And then post that, then obviously we've got those resolutions, which are important if it's a corporate trustee. Rob Materazzo, sorry if I got that wrong, Rob. If the resolution is very brief, that it shows the trustee, the trust name, says 100% distributed to a beneficiary with no further references to the deed, will the ATO fail this, or is it still okay? Essentially, Rob, it's not so much the ATO, it's actually about whether it, first off, you need to check the deed. Does the deed allow you to do that 100% distribution to beneficiary? So the question there is, what are you actually distributing? So under your deed, is it accounting income? Is it taxable income, or is it taxable / accounting income, or is it something in between? So that's the first thing. So your resolution needs to have reference to that. If it all goes to one beneficiary, that's fantastic. But what happens if that beneficiary is being litigated against, or more importantly, they're not alive, at that time, which is fairly crucial. So look, my preference is, again, to be obviously from a LightYear Docs perspective, we want to make sure everything's as super compliant as possible and to make your life easier, which that's why it ties in really well with our deed. If you've got a separate deed, then you can see when you go through and do your resolutions with ours, you don't have to put the relevant clauses in there. And then what we do is we just cover it off and say that's allowed under the deed. But again, it's still, you have to reference it back from that perspective. It's just too easy, really, for the commissioner, or wouldn't you say, Mick? It's a great way for them to make money at 47% if they wanted to.
Yeah, it's quite interesting. I mean, if you actually go to the ATO website, they actually say that they can be made verbally resolutions, but they also said it depends on the deed. So here comes the importance of the deed as well, that you go back and see what's required under that in terms of making a resolution. But they also go on to say that you need to be able to provide substantiation or proof that this actually happened. So on that resolution or that meeting to decide that has occurred. So I think that's extremely difficult if it's done on a verbal basis after the fact. But
yeah, I know it's look, we all know what the law is, and we all know how the tax law is going to play it. And many of us, you just sort of grin and bear it. He hasn't audited yet, but at some point in time, may well be the case. I think the main thing from our perspective is obviously we want to make sure that you guys are covered and it's it's as best as possible. The good thing about it is, again, if you go in and let's say it's exactly the same as last year, you just want to show everyone how you relaunch and then change the date for next year.
Sure.
I mean, what I would do, and I'm not sure what you do in your accounting practice there, Michael, is when you have a look at that, do you, it seems to me from a business perspective, the best thing to do would be to get those minutes out maybe in May or whenever, or June, send them out, just prepare them, print them out, send them to the client. I'm just saying that these need to be signed. Is there any changes? And that way, at least you're in front of the game.
Yeah, I think so. I mean, it's a great opportunity too. I mean, COVID really put the accounting industry back in the forefront in terms of JobKeeper and the need and the value in terms of up-to-date financial information. But their trust resolutions and minutes in relation to those resolutions helps that even further in terms of ensuring that your clients' financials in terms of their trust are brought up to date or up to date on a regular basis. So which helps in terms of determining what the distribution is going to be or what it's likely to be going into 30 June. So it's a good opportunity in terms of getting in front of the client, getting the information up to date, obviously earning fees around that. But yeah, so in terms of relaunching, so I've just gone back into the site. I go into my document storage. I'll go into my vault. For this one, I've got it, where did I have it under demo, I think? Where is demo? Demo. And trust distribution minutes you've seen just then from the webinar. So I'll just go in this nice little rocket ship, which is to infinity and beyond. So I'll click that and it will, it's just in the process for relaunching. Might be a little bit slow because I'm on the webinar. It should relaunch. I don't know what's going on there. I might have pop-ups blocked actually because I've
oh yeah, no, you would.
Yeah, there we go. They're all pop-ups. Sorry, I've had my admin stuff doing. I haven't been in using it since I've. Oh,
that's okay. That's fine.
Go back into the demo folder. There we go. Now pop-ups are unblocked. So it's simply as a matter of doing that. I'll go back through, make sure, check it, obviously, make sure there's been no change of trustee. Obviously, we've got great system in relation to if you need to change trustees from individual to corporate, or you need to change the corporate trustee throughout the year, but make sure that all that those details are up to date. Update when the actual meeting is going to be held, when that should be the actual date that they're making the resolution. And then all we have to do is go through and update, assuming there's been no amendment to the trustee, go through and update the financial year. So I'm going to update it to 2022. Then I'm just going to go through and update my distributions if I need to. So I'll give 50% of that.
I think it's important because there's been a couple of questions that have also come up. So when we do the, so the first point is you need to have a trustee meeting. So you start off with the deed, and we've had a look through ours. So the trustee needs to make an allocation or set aside an amount for a person, for a beneficiary. So we have to check the beneficiary, so on and so forth. So that's the first meeting, and it can be all encapsulated one. So we need to make have a meeting, and then out of the meeting there'll be a whole lot of proposals, and then there's a resolution. So if you have a look at ours, it goes through, this is what they're looking at, categories of income, beneficiaries, so on and so forth. And then the trustee resolves to make those payments out as per the beneficiaries, as per those categories. So it's a process going through. A trustee, if you've got a corporate trustee, can't just resolve something, because they actually have to have a meeting to resolve one. Otherwise, right, it's illegal. So you have the meeting and then the resolution at the same time. A resolution is something that comes out of a meeting.
Correct. And so, yep, bang, we'll just download these again and we're done. Send them out to the client for signing. And we're finished.
Okay, I've got Steve's come through, which is quite good. I might take this offline anyway and have a look at what we've got. Steve said TR 2010/3, where a UPE is satisfied by being paid out or lent back to the trustee, the UPE is effectively replaced by an ordinary loan from the private company to the trustee. Absolutely. This will be seen to happen on 30 June 21 in the deed. So an ordinary loan exists, not a UPE. Steve, the issue about that is the deed will never have that in play. So what will happen is you'll see in the powers of the trustee in the deed whether it's got the power to make a loan to the beneficiaries for that matter, and you'll find that most deeds will allow that. So the resolution that comes out on the 30th of June 21, if you have a look at the deed should have, or certainly our deed says that's it, it's all done and dusted. So it's all off our hands. But now it means that there's an amount effectively that's gone from one to the other, which is the beneficiary. So what we call it unpaid present entitlement because it's sitting on the books. Again, remember this has to be accumulated, set aside in the accounts for the beneficiary. So as long as that happens, then there's nothing further that is really discharged. Obviously, it's an amount that's going to be owing. And then it's up to the beneficiary to tell the trustee how to pay that out. But what we do is we just leave that outstanding. My preference would be to have, again, if you have a look at what the commissioners basically said there, is we either pay it out by way of a promissory note or by way of a loan, which is absolutely crucial for that one. So I would say that, if you look at 30 June 2021, it's, if you look at the 1st of July, it's a UPE, but a UPE probably is going to be very close to being a loan. Certainly, if you have a look at Commissioner's guidelines around Div 7A, distributions to bucket companies, that's financial accommodation, because obviously we haven't got a loan. So preference would be 30 June at the same time, there would either be a loan agreement or a promissory note. So here's a good one, Steve. Maybe worthwhile, probably not at this stage, but when we get LightYear Docs 2 this time next year, when we come around to doing that, it'll auto-generate a promissory note or a loan agreement, so you can make a choice around that one. And if we do that one, then it's all done and dusted for that particular issue. And then in terms of the underlying terms and conditions of that loan, we could actually make that a Div 7A loan as well. So that's a good point. Once you go down the rabbit hole, you can't get out of that one. So again, you can start to see it's that deed really is important. We have got up on our strategy centre a session of me upgrading the deeds. Just a heads up on what's coming up. Mick's got ESOPs on Thursday, which I'm super excited about. Some fantastic stuff around that, and we've built what I believe is a revolutionary employee share plan in Australia. So very excited about that. Tomorrow I'm just going to go through a whole lot of property stuff and SMSFs. So if you've got a client with any property in there, we're going to be looking at tenants in common. We're going to be looking at LRBAs, going to look at demolition of properties and reset up. We're going to look at farmland, a whole lot of other stuff. So that would be something that will be great. So make sure you come along to that. And don't forget, it's not too late to sign up, obviously, for that 3-day course. And I've got some very, very special stuff that will be coming out through that course. And your confidence is going to be absolutely well and truly above. Steve, again, thank you very much, Steve. So we intend to use the ATO UPE conversion process to at least defer the UPE that converts to a loan in 2022. So you've got that 1 year. ATO deems unpaid 2021 to become a loan in 2022, at least buys a year and having a start, which isn't a bad idea. Again, we could probably always do the promissory note, but again, that's very generous from the ATO because that law effectively, if you have a look at most trustees, the beneficiary can sue the trustee for recovery of that distribution at any point in time, which is one of the other reasons you've got to be very careful about cleaning up your UPEs if you've got adult children, because it's I've seen a number of cases where adult children sue their parents for trust distributions. But I'm sure that probably will happen with my daughters. You never know. But let's hope it doesn't be the case.
I've seen it as well. Yeah.
I know. Anyway, thanks a lot for that. And again, make sure you get along to the ESOP session on Thursday. It'll be great. And we use Cake for those of you who are involved in our capital raising at the moment. We're doing a very small one to get that LightYear Docs 2, which is really progressing very quickly. If you're still interested, have a chat with Michael. We've already hit the minimum, so we're well and truly on the way. So it's going to be very exciting for that. But just Michael at lightyeardocs.com.au. We use Cake for all our shareholder discussions and tables and all that. So that'll also be extremely exciting to watch that on Thursday as well. So thanks a lot for that, Mick, and happy birthday for tomorrow. It'll be a lot of fun. So unfortunately, I can't come down to the Gold Coast for it, but
understand.
I'll send a couple of my emissaries down there. So watch out.
Yeah, there's a few coming down. I think we've got 8 or 9 going out to lunch. So we'll try to behave as much as possible.
Excuse me, that's exactly why I'm not going down there. that would take me out for the week, and I've got a lunch with Tim Munro on Friday, so I need to be fresh for that. Plus, I've got to do all these documents for you guys. So, because I promised Steve to do a whole dividend Div 7A solution. So, anyway, thanks a lot for attending, everyone, and we'll see you soon. Happy birthday, Mick.
Thanks.